Hi student, good day. This is our chapter 4 for financial reporting, F7, impairment of assets. So impairment of asset is a very easy, it's opposite to fair value. So if some asset auditor feel or as the accountant feel, company management feel is the value is getting down, so they will that is called a impairment of assets. If some assets getting losing their value worth than the depreciated amount. If depreciation is something different, we evaluate over the period of time, but sometime due to any circumstances assets value getting down or devalued according to the circumstances. So this is what we will be discussing today under this impairment of assets definition, how it is measured. So under this chapter we will see the define, calculate and account for impairment losses, how we consider treated in our books of accounts, account for the reversal of impairment losses as an individual asset. So identifying the circumstances which may indicate impairment of assets, which we will discuss in more detail. Describe what is meant by the cash generating unit. So cash generating unit is the one unit in the company as a specific department. If it is a cash generating unit, so how it is valued and how it is treated in the books of account. And then we'll discuss this, how the CGU can be impairment losses can be determined. So under this criteria we will look into the way, the rules, how the standard is identifying the recognition procedure. So this is the impairment of assets is there under IAS 36. So indication of impairment. What are the indication, how it is impairment of the asset can be identified, we will discuss. So what is the measurement or impairment recognition criteria, and impairment of CGU, it is also will be discussing over here. Under according to the definition of impairment of assets, the objective is set to rule to ensure that assets of entity are carried at the no more than their recoverable amount. So it is if it is a recoverable amount is 1 million, and if books of account showing a 1.5, so auditor or company is not allowing to show in the books of account for higher value. So these way, you as an accountant, you as a future chartered accountant or auditor, you have to identify this part are also tested in your audit paper as well, and your other paper for tax purpose also. So you have to remember this topic is linked with the other studies as well. So under IAS 36 applies to all assets other than inventories, the construction contracts, deferred tax, assets arising from the employee benefit excluded from the financial reporting your examination, financial assets including within the scope of IFRS 9. So investment property measured at fair value under 40, non-current asset classified as held for sale. So this is remember, so IAS 36 apply to all assets other than these following assets. So because these assets are already in the discussion in the market in the negotiation stages, so this is the reason. So there is impairment is not applicable to this, and this is the main important rule which you remember. The impairment of asset is impaired if its recoverable amount is below the value currently shown in the statement of financial position, the assets carrying amount. The recoverable amount is taken as a higher of, remember, higher of the fair value less cost to sell, net realizable value, NRV also remember for their abbreviated term. So and the value in use, the example of the existing carrying amount, the recoverable amount, the greater of any of these two, value in use are the fair value less cost to sell. So great should be greater of. So remember this rule, it will be, if you remember this one only, it is your answer, your will be easier to explain or to get your exact figure. So how you are going to recognize in the books of accounts. Measurement of recoverable amount, the fair value less cost to sell. The measurement may be way of bringing the sale agreement or binding it into the agreement and the current market price less cost to sell of disposable where an active market exists. Measurement of value in use. The value in use is a determined estimated future cash flow and outflow to be derived from the use of the asset and its ultimate. So these are the cash flows relating to the financial activities. Income tax should not be included in this calculation. So this is illustration will clear your doubts. So the following information: carrying amount 100 for project A, B, C. This is 150,000, 120,000. Net realizable value 110 and 125, and then value in use 120 is a value in use for this project, and value in use for 98,000 is for this project. So what is required? So what is the recoverable amount of each asset? Calculate the impairment loss of these three assets. So what is the impairment loss of these three assets? So asset A is the total recoverable amount of the assets is 120,000. This one, like asset is there. B, asset B is 130,000, and the asset C is the value is 100,000 according to this one. Okay, so because this is net realizable value, so we have to follow the value the greater of these two rules, you remember. So this, which one we just now we have gone through. Like this one, greater of fair value less cost to sell or value in use. So these two rules we have to consider. Now, according to the impairment loss will arise for the following calculation. For the project A, it will be a net realizable value of 120 is a greater than from carrying amount. So, or the net realizable value. So, it will be no impairment indication is there here for this one. So, here is 130. So for here one for project B 130 is their value in use, and this is a way for 150 and 130 is a 20,000 is their impairment indication for project B, and project C is there also a 20,000, 100,000 and 120 is a difference of this one. This is a 120,000 is a impairment for project C is also indicating for impairment. So indicator of impairment again, now you understand. So IAS 36 require each reporting date and entity must assess whether there is an indication of impairment is there. Indication of made because remember during the previous times whenever any circumstances happen or natural calamities, so this is also they can cause impairment like corona. Say there was a so impairment of in lot of assets or lot of nature of assets, there was a impairment in business and their losses, some many big losses were there. So it was also in, they have to see according to the indication. So internal sources of information: evidence of obsolescence or damage of the assets. The same thing, if any earthquake is happening or natural calamities, any obsolescence or some asset is getting obsolete or new technology is coming, so it is it's immediately they have to recognize, like now new IT things are coming. So if you have an old system, so it is not they going to retain the value in the use. The change in the way that the asset use have occurred or the imminent. Okay, this is also a reason can be there. Economic performance of an asset or anticipated to be worse than expected. So now the if any IT related things there is no though there is no guarantee for long term use. So it can be impaired within the period of 12 months or maybe 24 months. Annual impairment reviews, whether there is indication of impairment, there is no further action needed to be taken. Exception of the rules: goodwill acquired in a business combination. Okay, exception for this: an intangible asset with the indefinite useful life, or intangible asset not yet available to use. So this is can be excluded on this one. Recognition of measurement of an impairment. So where there is indication of impairment, an impairment review should be carried out. For recoverable amount should be calculated immediately. The asset should be written down to recoverable amount. So whether whatever recoverable amount is there, like they will see, evaluate they get a quotation from the buyers. So how much they just giving offer for the asset. So they that's the same like a valuation method, or they will calculate the impairment losses. Impairment losses should be immediately recognized in the statement. See under this one, what they are asking: identify the recoverable amount of the car and any impairment required. So what is now the story? The entity owns a car that was involved in an accident at the year end, and it is barely usable. So the value in use is estimated $1,000. However, the car is a classic antique car or something like that, and there is a demand for the parts. The result in a fair value cost to sell is a $3,000 is anticipated. The opening carrying amount was 8,000, and the car was estimated to have a life of 8 years from the sale start of the year. So identify what will be the recoverable amount. So first of all, it is amount. If we consider amount in thousand, so it's the first recoverable amount of the car is 800,000, and then it is carrying amount of will be estimated for 1,000, and then its value. What value is coming, and then after that we have to consider cost to sell is a fair value cost to sell is a $3,000 is a cost to sell. So this is a balancing figure will be our impairment. We will have to consider for the impairment. The impairment will be like 4,000. You have to apply for impairment like 8 minus 1 is the value which we anticipated 7,000. The 7,000 now we have a value in use is 3,000. So then whatever is the difference is a impairment. The 4,000 you have to consider in your financial statement immediately. So this rule, this is the way how you will calculate. Now we'll see the test your understanding. Number two, what they are asking, what is the amount of impairment? How should this be treated in the financial statement? Entity owns a property that was revalued at 500,000 on 31st March, and with the revaluation gain of 200,000. Revaluation gain was there, and which was recognized as in the comprehensive income and recorded as a revaluation surplus. So revaluation surplus, students, this is kept in the books of account under the revaluation surplus, and whenever they need, so they can reuse that one. So now again they're saying at the 31st March 2005, the property had a carrying amount of 460, but the recoverable amount of property is estimated to 200,000. Now again there is a change in the figure is coming. So according to this change, now they are saying the carrying amount of the asset is now 460,000. 460,000 is the carrying amount. From this carrying amount, you will deduct this 200,000 revaluation gain, which is only property estimated recoverable amount is 200,000. Remaining 260,000 is there, balancing figure. So which is required for impairment. So out of this one, so we will immediately we will net off the 200,000 whatever was the surplus was there in our comprehensive income. Other valuation surplus was there. We will net it off from 260, and 60,000 we will book in the income statement, charge to the income statement immediately as a revaluation, as in the statement of profit and loss as a impairment of this asset. This is the way how you will treat in your books of accounts. So now there is a reversal of impairment loss. How your impairment loss will be reversed? The calculation impairment loss is based on the prediction whether it happen in future sometime, like same like the above case which we discussed. Impaired assets should be reviewed on each reporting date. Okay, so reversal of an impairment loss is recognized immediately in the income statement. The reversal must not take the value of the asset above the its depreciated historic cost. So the depreciation charge for the future period should be revised to the reflect the change in the carrying amount. So these one will have to look into the details according to the scenario, according to their requirement. So these are the indicator for the impairment reversal. External indicator of impairment reversal are increase in the assets market value, favorable change in the technological market, economic, legal environment, decrease in interest rate is also there according to the impairment review. Internal indicator of impairment reversal, favorable change in the use of asset, improvement in the assets economic performance. They is performing well and they can reverse the impairment amount is they can reverse it, like how this is a example is this one is stating each explain the supporting. Here and they saying the illustration reversal of impairment, a boxer purchase and non-current assets, the cost of 30,000 at the date of assets and estimated useful life of 10 years. 10 years is a boxer's assets life, but does not revalue this type of asset, but the account of it in the basis of depreciation historical cost. They were saying the impairment review recoverable amount was 16,000 on December 2002. On January 1 to 2002, they have such a figure. So recoverable amount is 16,000. On December 31st, 2005, the circumstances which caused the original impairment to be recognized and revised and are no longer applicable, with the result that recoverable amount is 40,000. Now explain whether the supporting computation and the impact of financial statement for the two impairment reviews. So how you will consider in the books of account for the first change happen, like first 30,000 was there in the books of account when they purchase the asset in the on January 1st. On depreciation 30,000 by for 2 years, so 30,000 for 2 years, 6,000 they have applied over here, like asset life was a 10 year as it is stated over here. Okay, life of the assets is a 10 year, and then 6,000 depreciation deducted, carrying amount 24,000, and but a recoverable amount according to this review, it says 16,000 is a recoverable amount, so mean balancing figure will be the 8,000 is the impairment loss for this scenario. So this scene for first example, it will be like that. And the other example, the asset is written down in the books of account for impairment loss for 8,000 and charged to the profit and loss immediately. The depreciation for per annum is a remaining for 8 year, 2 year before previously the charge, and now 2,000 will be for annual depreciation will be charged for the next coming year. But now for December 2005, as they said, it is reviewed as a 40,000, remember, and the carrying amount is a 16,000. And then in 2005, so there is again 3 year span is already gone. 6,000 is they have a charge the depreciation. The 10,000 is the carrying amount, but recoverable is 40,000. Now it is showing in the books of account. Impairment loss is a nil. So this is now value in the use is a higher, greater than the actual value. So there is no impairment indication of this type of question. Okay, student. Now we coming to the cash generating unit (CGU). What is a CGU in the financial terms? It is a very common in your upcoming questions. Also, there when assessing impairment assets, it will not always be possible to base impairment review on individual asset. But the value in use calculation may be impossible in the single asset because the individual asset does not generate a distinguishable cash flows. So in this case, impairment calculation should be based on the CGU. So if it is the whole business unit, it applies over there. In the business unit is a given example, like in the restaurant chain, the smallest group of asset might be the asset to win the single restaurant, but for the mining company, all asset of the company might take into consideration as a single generating unit. This definition, students, you have to memorize according to IAS 36 para 6 is defined as a smallest identifiable group of assets that generate cash inflows that are largely independent of cash inflows from the other assets. So how impairment is calculated on CGU? This is also very simple and easy. The impairment assuming cash generating unit is a one set as a all everything is included, comparing the carrying amount of CGU to recoverable amount of CGU. Carrying amount of CGU is equal to amount of all assets in CGU added together, and recoverable amount of assets CGU added together. As previously discussed, an impairment existence where the carrying amount of existing recoverable amount. Impairment of CGU will applicable. How this is applied over there? Same like that. So purchase goodwill, deal with the specifically impaired assets first, then impair CGU. According to IS 36. So the order following order will be write down the purchase goodwill, the other assets including in the intangible assets CGU, and the pro rata basis they have to allocate, or they have to. Okay, student, we do see this test your understanding 5. Number 1, following information relate to 3 assets: asset A, asset B, C. Their carrying amount this much: 100, 50 and 40, and then where value in use this one, and then fair value to less cost to sell is a 90, 65 and 30. So how it is how we will calculate the impairment review for all these assets. Like this is carrying amount is there for this one is 100, and then fair value in use is 90, is a 10 is there for its amount will be calculated over there. And then 65, it is its value, fair value in use, and the carrying amount is 50, we consider it 0 so if it's a greater of. And then here it is the value in use 35, and fair value is a 30, here we will bring it to 5. So what is the total impairment of these assets is a 15. So this is the way how we will calculate the impairment. So student, this is all for the chapter review and our understanding which we have gone through. So student, this is all from study text, Kaplan study text. If you are willing to gain your complete understanding on the revision kit, pass card, and if you want to have this study material as well with you, you have to become a member, student member, and join as a student for 90 days. You will get all these documents of study material, soft books, and revision kit, live classes. You will have a WhatsApp support as well. So we will provide you all a complete study support up to the exam day. So keep learning and get in touch, and wish you all the best. Thank you.